Okay, so moving on with respect to public finance, market failure. What is the meaning of market failure? Free market leads to misallocation of resources either on the demand side or on the supply side. So imagine what will happen to the traffic if traffic policeman was not there and traffic signals are not there. You just tell them, this is your road, you manage yourself. You somehow manage it. Many times we do, but we can't always expect the people to manage themselves. We know that economies are driven by market, but every time that equilibrium point may not be accurately achieved. Why? This is like telling, will the price will always be fair? When you go to a shop, will the price will always be fair? May not be, right? If you don't know about the product, they will easily mislead you. And fraud in India is even more convenient and popular. So if you don't mention the gram separately, if you don't mention the weight separately, if you don't mention the product separately, they will easily mislead you. So some Nike, instead of putting that dry tick, they'll put some small down tick and sell it to as Nike shoe because you don't know about that information. So either on supply side or on demand side, the price will not be perfect. The market forces, demand and supply, may not lead to fair valuation. So in those cases, it is called as market failure. The price may not be fair. So because of the market forces, if the price is not fair, it results in market failure. Let's look at the reasons one by one. We have market power monopoly. You know, if the product is produced by same company, for example, you see monopoly or monopolistic competition, you can say. After the Reliance Jio has come in, we are using the internet so freely. Before that, what was the case? How they are charging Airtel? I explained you how Airtel and Vodafone India and all, they are exploiting consumer basically. So Jio came as a pleasant gift for various people. I'll give an example of stockbroker. You know, before Zerodha came in, there was so many people, so many brokers charging 1%, 2%. So if they charge 1% on buying, 1% on selling, unless stock moves 2%, we could not have made money. No, Zerodha came in and flattened. They said we'll charge us flat 20 per order, no matter how many crores of rupees you buy. We charge you 20 per order. Now many brokers are moving in those lines. So when ICICI, SBI cap, this one stalwarts are there, how could Zerodha come in? I mean, before Zerodha come in, they were charging monopoly. Of course, their market only had an answer. Somebody else came in and the market is stabilized. But it may not happen in every case. Government may need to intervene. Like, for example, let's say school fees. The private tuitions might charge too much. So government sometimes may have to come and intermediate. So monopoly leads to market power, and when only few companies produce those goods, the price market itself will not be there much. So market will have a failure. Then we have externalities, also called as spillover effects, which means when you produce something, you produce more than what is required. Or when you consume something, you consume more than what is required, what you pay for. You get something extra, spillover. For example, smoking. And do you know people? Those people who smoke will not become old. Do you know the secret? If you smoke, you will not become old. You know why? You will die young only, no? How can you become old? So, in a way, smoking and yoga, meditation is very similar. How in yoga or meditation, what they tell, take a deep breath and slowly breathe out. So in a way, you're doing meditation also, yoga also. But anyway, so smoking is an example of spillover effects. What is that? You consume, that's okay, but person sitting next to you, standing next to you, passive smoking, even more dangerous. They are not smoking, but they also will get that air. They will have that pollution. They will have that problem. That's called as externalities. And to be specific, it's an externality during consumption. Therefore, it's called as external negative consumption external. Smoking is example for negative consumption external. You are consuming and it is having negative. Similarly, negative production external also can come. You produce, let's say, steel company. They have lot of chemicals out, waste, may not be biodegradable, might reach river, might be a water pollution. That is, in the process of production, something extra comes which affects the social cost, public good, social cost. That is called as negative production externalities. Positive also can come when you produce something, it can have more effect also. For example, you lay down roads. Roads are constructed. Let's say some private company construct roads and government pays for it. But in the process of that production, it may be public library, it may be park, museum. In the once you produce goods, once you give services, it will have a spillover effect. It will have much more positive impact. That is production externalities. Consumption externalities also. Suppose you consume something. In the sense, suppose company pays the employees, please attend this seminar on GST. Not only employees gets, company also, not only company gets the benefit, because company, the employee will get a GST knowledge. When he goes to some other company, his knowledge will continue. So the consumption will still continue. So in the process of consumption, you will have lot more benefits than what you pay for. That's what is called as externalities. So for these reasons also, the market price will not reflect these externalities, for which the market may be a failure. SCB, that is social cost benefit. In the sense, when you spend something, we should not only consider the private cost, we should also consider the external cost. So social cost is private cost plus external cost. The public impact will be there. Example I told you, smoking. Not only you paid for the smoke cigarette, but you're causing the nearby person also a problem. Manufacturing companies, chemical companies. You produce chemicals, that is the private cost, but in the process of it, you pollute uh, the environment, that becomes external cost. Equilibrium point is the point at which marginal private cost is equal to marginal private benefit. Uh, can we say COVID vaccine will be an example of positive consumption? Yes, definitely. You are consuming COVID vaccine, so it's good for you. And when everybody takes it, it's good for whole society also. Society's health also will increase. Definitely, it's a positive external, positive consumption externality. Okay, so when you what at what point, how do you decide that this is the equilibrium point, or how do you decide to what extent we can incur private cost? We just say that marginal private benefit, incremental private benefit should be equal to incremental private cost. If that is the intersection point, marginal benefit is equal to marginal cost, and that is the equilibrium point. Then also something called as public goods. Again, public common goods, I need not tell about Indians things, that common goods we don't pay for it at all. Electricity, somehow we use it. There is one statement also. somebody that Kunal Shah, I think he's the one, I mean, he's the startup, is the MD or something, who started the Cred app. He made one statement. He told, in India, electricity or electric vehicle will be definitely a success as compared to petrol vehicles, because he tells, in India it is easy to uh, it is easy for the theft of electricity rather than taking petrol. I mean, the electricity will be easily, or the thief will be there who can easily take the electricity out. So therefore, in India, electric vehicles will be a success. But anyway, but our problem, we really don't value the common place, public place. You go for any monuments, historical monuments, look at the way it is kept. I'm not blaming the authorities. The people mentality is that whenever there is a strike, we damage the public goods, public property. It's our property. Ultimately, we end up paying more taxes. That's what is public goods, because it looks free. It's not mine. We get that feeling and we easily damage it. We don't take care of it. You look at the roads nearby. Look at the common place, government office. How does it look like? How it is being taken care? Public park. We just throw everywhere. Any garbage, everything. Even when you go to film theater, you should have seen some places because it's not mine, no. So I can do whatever I want. People will not value. Anyway, so because of those public goods, common goods also, the price will not be reflecting it. Market will be a failure. So what are public goods means? Collective in nature. It's common for everybody. Park, museums, military, police, all are examples. No direct payments. So, if police forces military, now military is there for your safety purpose, and they will come in many other places, like in case of natural calamities, they are the first one to come and help. Now, do you make any payment to them? Oh, thank you for helping, take this payment. No, you don't have a direct payment. That is the nature of common goods, public goods. Non-rival consumption, in the sense, many people can use it simultaneously. You can also sit in park, other person also say you can sit in park. Indivisibility, you can't say this is exclusively for me. I mean, non-excludable, you cannot exclude others' problem. I mean, once you're using it, you can't say this is mine. That is called as non-excludable. There are some quasi-private goods, quasi-public goods. I'll come to it. There is an example to be given. I'll come to it in a moment. Free rider problem. Some short notes also can be asked on this. Free rider problem, especially in India. Government, to support the poor people, deprived communities, they give some services, they provide some benefits, incentives. But many people take disadvantage of it. They exploit it. Free rider problem. Something is available free, maybe food, or maybe some clothes or some ration products and all. And there is one beautiful sentence, I'm sure you also might have seen in Facebook and social media, which said, there is nothing free in this country. Everything which is seem free is actually paid by a taxpayer. It's sourced from a taxpayer. Nothing is free, because government ultimately taking money and giving something free. So what's the problem of those who free people who consume something who don't give any benefit? And it's okay for a certain level, but they keep on using the same thing over and again. They exploit it. That becomes a problem, and that is why I believe we require good technology to track who are getting this benefit, how long they are getting this benefit, are they exploiting it? Because a lot of these middlemen and all will be there. They simply exploit the public also, they exploit the government also, these road contractors also, corruption everywhere. So the money will be paid by government, but other person will not give a sufficient service or will not produce sufficient products. That's called as free rider problem. They get the benefit, but they don't give anything back. incomplete information, asymmetric information, or adverse selection. Again, I told you, if you go to a place, especially, if foreigner comes to India, and many people don't come to India for that reason. Foreigner comes to India, how these auto fellows, cab fellow will exploit them, because anyway they will pay in dollars, right? I mean, they'll think in those dollars. Instead of charging 10 50 rupees, they charge 2000 rupees. They'll also pay, and they go and tell their experience. People will not come back. Many places, in hotels also, restaurants also. Even if you go to as a tourist somewhere else in India only, how people will take you for a ride. They'll exploit easily and they enjoy. They tell themselves, I fooled so many people. Asymmetric information, adverse selection. Because you don't have information, you don't have knowledge, and you don't have power, the price what is charged will not be fair. Market force will fail. I was trying to tell about two aspects. I would like to cover it here. One is rivalrous and non-rivalrous, excludable and non-excludable. You have to understand this, and this will help us idea about private goods and public goods. Rivalrous means uh, okay, excludable. Okay, rivalrous means once you use it, will it get depleted or not? See, for example, you purchase ice cream, you purchase idli, you eat, you drink, that will come down. That is called as rivalrous. Once you consume, that is exhausted. The value has come down. So, food, clothing, cars are all examples. Non rivals, you can consume, but it will not reduce. For example, club goods, cinemas. You go and watch cinema. You sit and watch cinema. So, will the value of the service cinema comes down? No. But it is excludable. What do you mean by excludable? Excludable means you can prevent others from using it. Cinema hall, same example we can take. You make a payment, you sit. That place is reserved for you. It is for you only. You can, if somebody sits, you have a right to make them leave. It is exclusively for you. You can prevent, you can exclude others from using it. So if it is purely private goods, they are excludable as well as rivalrous. Excludable rivalrous means it is only for you, and once you consume, it will come down. They are pure private goods. Then we have non-rivalrous and non-excludable, pure public goods such as national defense. It is for everybody, not only for you. And once you get the benefit, it does not mean others will not get the benefit. So non-excludable, you cannot prevent others from using it. And non-rivalrous, the value will not come down once you consume it. They are called as pure public goods. Then we have combination of both, quasi-private goods or quasi-public goods. Look at this. Rivalrous, non-excludable, such as fish stock, forest resources, coal. Now, coal, like forest resource, once you consume, once you consume, if the value will come down, you go to the forest, pluck the fruit, you eat, it will come down. But can you say forest only belongs to me, others should not come? You cannot stop others from entering. But once you consume, it will come down. That is rivalrous, non-excludable. Then non-rivalrous but excludable. I think I already gave the example, cinema hall, where once you watch the cinema, once you consume cinema, that will not come down, but you can prevent others from using it. So remember these four categories: rivalrous, excludable, pure goods, pure private goods, pure public goods, quasi-private, and quasi-public. Okay. Uh, Now, government interventions. So, market failure. So, especially in India, we also called as mixed economy. We are not just market oriented people, and we are not socialistic. We are a combination of both. So, when the market fails, government need to take some measures, preventive measures, corrective measures, or supportive measures. What are those? So, we are having the list now. In what ways government can prevent this market failure? Minimize the market power. I told you monopoly is a problem. So you start your own entity. We have Competition Act so that the market forces, the giants will not come together. We ensure that there will be competition. There will be no monopoly. Competition Act has been introduced. Rate regulations, the price of commodities regulated, auto prices, petrol prices controlled, regulated. It's not completely because private people also will be there, but at least government will have some sort of regulation, some sort of control. Correct externalities. Externalities we discussed for which market will be a failure, like pollution, smoking, those kind of things. So we can have a direct control measures or we can have market based policies. What is direct control? Smoking is prohibited. Direct control. Or these kind of products are prohibited. We had like electric smoking, e-smoking or something. Those machines are to be scrapped as if regular cigarettes give some oxygen. So when you directly prevent it, when you stop it, no, these are banned. These products are completely prohibited. Direct controls. We can have market-based policy, like we can give some limits, some restrictions. Like you can produce only up to certain level. You can export only up to certain levels. So these kind of restriction can be there. Some license can be given. So we will give you license provided you get the environmental clearance certificate. So Tata, steel companies, energy companies need, these infrastructure companies, industries should get a clearance certificate, environmental clearance certificate, market based policies. We have two types of goods, merit goods and demerit goods. Merit goods, as the name suggests, good for society, food, health, education, advanced education, good for society. Government will participate, should participate more and more. Hospitals, clinics, colleges, engineering colleges, medical institutions. Demerit goods, undesirable, but still they will be there, like alcohol, cigarettes, uh, which are not these gambling places. They are really not desired, but they're still there. So government need to control it. That's all. Price intervention, minimum support price, especially for agriculture. You would have seen in news also. When price falls for market reasons, farmer will suffer a lot. So to support them, government will announce a support price for rice, wheat, sugarcane, various things. Rent control. So you know that the landlord cannot exploit the occupants, tenants. We have a rent control act, beyond which rent charged means that will become an offense. Minimum wages. We also have minimum wages act. I don't know whether you have that law, which ensure that this is the minimum amount to be paid if he is hired as a worker or a factory person. Minimum wages. Correction regarding information failure. So information is not passed to the buyer. He don't know what is the product, who produced it, how much content is there. For that only we have labeling, labeling, emblem, labeling. Some act is also there. So disclosure should be there. When you buy a chips packet, it should have the date of manufacture, date of expiry, and batch number, place, who is marketing it, where it is produced, especially regarding medicines. Food and all, it's okay. But what about medicines? If medicines are expiry date, then person only can be expired. No? And I always had this doubt, just came to my mind. So I'll just tell you. A few things they will tell, no? Or if you have a non-stick, I mean, if you have a, sorry, Fevi-stick, you know, Fevi-stick will come. If you put it on non-stick tawa, Fevi-stick, if you put on non-stick tawa, who will win? Because one is stick, other is non-stick. Who will win? I don't know. Similarly, if poison poison gets expired, expiry date is over. If somebody consumes it, what will happen to them? Poison, they will die, or expiry date is over, so they will still die. Anyway, so few terms in English you'll always have it, like naturally act. How can naturally you act? Correct? Natural or act? This is a small crowd. How can small crowd will be there? Crowd means big only. How can it be small? We say happy married life. Both words cannot go together. Anyway, let's keep it aside. So to avoid, yeah, little more is one more example. To avoid this information failure, to educate them properly, to provide proper data to the users like food packet, expiry date, medicines, we will have a disclosure, measurement, date of expiry, and the date of manufacture and batch number, where it is produced. So much data. Equitable distribution, that is to ensure that somebody will not get too much of money, or we just try to maintain the redistribution. For that we have progressive tax, unemployment compensation, for which I think India is yet to have it, US have it, jobless claim, transfer payments, payment of pensions, annuity schemes, social security schemes like insurance, common insurance. I think these things, insurance is coming these days. Some people are taking more seriously, which is very good thing. Which is uh, common insurance, crop insurance, for insurance for agriculture. You know, farmers will always have a problem of either rain is not good or market is not giving proper prices. Sudden some issue happens with respect to the consumption. Why don't we have a insurance? They may not be educated. Government only can pay in small amount the insurance. So we also have some Pradhan Mantri, lot of yojanas are there. Even for insurance also there are lot of things. Small amount, if you pay them, some 200 rupees, 300 rupees and all is there. Very good schemes. You can check those things. It's good for everybody. Okay, this is government intervention to correct market failure. Then we have fiscal policy, especially, you know, budget. Every February end used to be there. Now it is February beginning, and now budget has lost its significance to an extent. GST Council has taken over because majority of the goods taxes will come under GST. So budget has become a tool only for income tax. So fiscal policy, I hope you are able to see this. This is small in your material. It should be big enough. Yeah, I think material is fine. Okay. So fiscal policy, that is government's policy, government measures, what they do to, I mean, how they manage tax, direct tax, indirect tax, what infrastructure activities they take place, and what policy they implement, reservation policy, education policy, health policy, all these things will come in fiscal policy. But main objective is to provide full employment. I have discussed earlier also. The objective is not to give free money to few people. it is required, but major job of a government is to provide employment. That is to empower the citizens, to empower the people of the country, not to tell them everything is free or not to exploit them by collecting every money. You give them the opportunity, you give them the employment. Give them employment means make them ready for it. That is the objective. Price stability, price fluctuation should not be there, with especially with respect to essential goods. Rate of economic development, the government should grow, especially developing country like India should have a growth. We have lot more potential to grow. We have a lot of good economic resources. We have national resources, financial resources, manpower resource, human resource. I need not talk about it. There are crores of people. So government should ensure it is supporting economy development. And there is a saying: many countries like China has developed because of government, and we Indians are developing in spite of government. A big statement. Anyway, so government job, public finance job is to support the economy growth at a larger level. Equitable distribution function we have seen as a stabilizers. Okay, fiscal policy can act as a stabilizers. We have two kinds. One is automatic stabilizers. Other one we have discretionary fiscal policy. Let me see if I have an example here. 1 second. Okay, we have it, but let me explain this first. Okay, automatic stabilizer means certain instrument will work automatically. Government need not do anything extra towards it. For example, progressive taxation. What is progressive taxation? As you get more income, you start paying more tax. If your income is less, you will pay less tax. So, if somebody is becoming richer, you don't have to take anything extra from them. Automatically, the tax will take care of it. The tax will automatically increase. When they have money, you will collect tax. The money, their savings will be stabilized. Or if they have less money, we collect less tax, and thereby they will have more disposable income. They can spend more on the economy activities. Again, the transactions will increase, economic activity will increase. That is an automatic stabilizer. So government need not do anything specifically, intentionally, consciously. The progressive tax system like that, it is automatically included. Discretionary policy where government has to intervene. For example, changing the tax rates, GST rates. GST on gold. We don't want gold purchases. We want to make them more costlier. Increase GST on gold. On milk products, we want to make it more affordable to people. GST, reduce it or remove it. So that kind of changes in taxes. Or recently what happened, income tax in petrol has crossed 110 rupees. So government want to give some Deepavali gift to the people to reduce the excise duty. So that some saving, I don't know what saving, but some saving will be there. So they are doing the decisions, they are doing it consciously. That is called as discretionary fiscal policy. Okay, what are the instruments? I give you a few examples. Let us take a look at it one by one. Just give me 1 minute. Okay. Instruments. One, government expenditure, government spending money, current expenditure or capital expenditure, transfer payments. Current expenditure, government paying salary to military, uh, government staff, administrative officers, lawyers, I mean not lawyers, judges, facilities, MP salary, and capital expenditure, construction of roads, starting some new business, investing in new business, construction of aeroplanes, HAL produces lot of aeroplane parts. They want to support electric vehicles, so they can government also can start with electric vehicles company, so that it can be given at a slightly cheaper price to the public. Petrol bunks they can start. I mean, just an idea. Transfer payments like paying pensions, taking care of citizens insurance. I told you directly, those kind of thing. Government spending the money. Taxes, encouraging or restricting, that is charging more tax. Private expenditure, size of disposable income, that is if you charge more tax, the disposable income will be less. You charge less tax, disposable income will be more, so thereby you can empower the people with more purchasing power. Public debt, that is government taking more loan from the public. Of course, government don't take loan from the public directly. They will take loan from banks, like you give the money to bank as deposit and they give the money to the RBI and government, etc. Public debt. So we have treasury bills, government bonds, from which the government can raise money, which can be spent on various current expenditure and capital expenditure. It can be external debt also. So when government is taking loan, it need not be internal. It can be external, in the sense government taking loan from World Bank, from WHO, from WTO, from foreign banks, from China. In fact, China has impact in lot of other countries because they have given loan to various countries. It's almost said like China owns Pakistan. Some people have it because they have given so much of loan. So many other countries also. China has given loan, those governments have taken loan. And when they cannot repay it, normally what you do in normal institutions, when the bank give you loan, you don't repay, they will take back, right? That's what China is also planning. But anyway, so government has can take loan within the country, internal, basically from banks, from the public, by issuing bills, by issuing securities, government bonds, or they can do it, raise the money outside India also, like taking loan from World Bank. Budget is also an instrument, and I told you, budget is limited to direct tax. Indirect tax is taken care by GST Council. Balance, surplus, deficit, budget deficit, how much money you have earned in the form of taxes and other revenues, and how much you are planning to spend, the difference called as deficit. And how do you balance deficit? Either you take a loan or you print more money, both of which are having an inflationary impact. So managing the deficit is an important job of government. We have two policy, I think I told you: expansionary fiscal policy, contractionary fiscal policy. When the economy is in depression stage, like corona situation, where people are not coming out, economic activity is not happening. It's all flow, remember, okay? Economy will survive because of the people who continuously transact. The moment you withhold something, that is not good for economy. Just like your body, you need to keep on eating, keep on consuming. The moment you eat and just have it, it becomes store, and that is not good for health. Same thing for economy also, it has to be in circulation, circular flow of income. The moment one thing stops, government should involve and start continuing it. So government has to involve activities like they have to give lot of incentives. Government should give loans. They should come up with schemes for the public, maybe to start the companies on their own, startup initiatives, so that more activities will take place. The economy will revive. Contractionally fiscal policy, in case of inflation, it happens when the prices are soaring, the economy is growing at a very fast pace, the prices are increasing, we are having lot of supply, so we have to control. I mean, we are a lot of demand is there, We have to control lot of money circulation, control the money circulation, reduce the government expenditure, don't do too many government projects. Let the flow of money come down. So in that case, the economy will be contracting, it will be stabilized. Okay, so this is regarding discussion on public finance, especially on fiscal policy. I hope the charts are helping you to an extent. Okay, fine. Let's go to the next chapter, money markets. That's a very interesting name, money. So, what is money basically? Please keep it in mind. Money just means purchasing power, nothing else. I'll just give one example. You know, we always have seen $1 equal to 75 rupees, £1 equal to 90 rupees, €1 equals to 100 rupees, one Singapore dollar is 40 rupees, one AED, the American, US Arab dirham, one dirham is like 17 rupees. We always have seen that. Have you come across any places where 1 rupee equal to so much? One example I can give you is Indonesia. So I happened to go to Bali one time. There I realized 1 Indian rupee is 200 Indonesian rupee. 200. I was suddenly surprised and I was very happy. So I had 1 lakh Indian rupee with me. So how much is Indonesian rupees? Can you imagine? 1 lakh Indian rupee into 200. Not 20 lakh, 2 crores Indonesian rupee. In a matter of few hours, while traveling from India to Bali, India to Indonesia, I became crorepati. I liked very much. I said, I think I'm going to get settled in Indonesia. Suddenly became crorepati. No, in a matter of few hours. When I landed there, the practicality hit me. Even if you have to go to bathroom, you have to pay 10,000 Indonesian rupee. 10,000. 10,000 divided by 200. 50 rupees, right? Or 1,000. I don't remember. Let's say 2,000. 2,000. Let's not 10,000. 2,000. 2,000 divided by 200. 10 rupees. 10 rupee you have to pay. In Indian equivalent, you have to go there and make a payment for bathroom. In India, nobody will pay so much. 10 rupee and all. And that too, if it is boys, they will not even pay it. They will go somewhere here and there side. Public goods. Which means the number may look good, but if it is not having ability to purchase, the purchasing power, if it is not there, money has no power. It has no point in being rich. I'm not telling philosophy here, I'm telling you the reality. Let's say at the age of 95, you are having 1,000 crores. What you can do with that? You can't spend, means it's a waste of money, right? So you are rich when you are having the ability to spend money. If you don't have ability to spend, then the money has no meaning. You're not rich. So you need money and you need time in life. Try to balance both. Anyway, let's go forward about the money. So what is the meaning of money? It is a medium of exchange. I want to buy something, so I would like to pay this. That's all the meaning of money. It's a medium of exchange. for transaction purpose, because earlier we had barter system. Just imagine if the barter system was there, how our classes and all could run. I come to the class, imagine physical class, you come to the class, after the class is over, you will tell, sir, shall I drop you? Because anyway you don't have money. And one more person tell, sir, I got fruits, will you eat in the break? Or some person will tell, shall I get breakfast for you tomorrow? Life would have been much different, but difficult also, because the division is a problem, conversion is a problem, because if we can't easily tell how one kg rice is how much kg of sugar, it's very difficult to divide, very difficult to transact, and that is how money came into picture, for easy transaction purpose, for exchange purpose. So functions of money: transferring purchasing power. That is what I told you. Primary functions of money is to give you the ability to purchase. And when you give the money to somebody else, your purchasing power became other person's purchasing power. So the transfer for transaction purpose. Decomposing barter. So we would like to remove barter system. Unit of value, so that when you have money, it has some value, it has some significance, so that it can be stored, it can be used later. Standard of deferred payment. See, imagine barter system. You borrow 1 kg of rice. You borrow 1 kg of rice. After 1 year, how will you repay in rice? For rice, can you say interest? Not possible. So interest and all we can add. Repayment is possible in money. It's very difficult in barter system. So in barter system, can you say I'll take 1 kg of rice, I'll give you 1.5 kg of rice back? No, it's very difficult to measure like that. So money is going to help in those situations. What are the characteristics of money? It should be acceptable. That's why I told you, if you have money, if you can't spend, it does not value. You go to some Andaman Nicobar island, you are lost. You are having crores of rupee with you, cash on hand. Whom will you give? Nobody will accept. Nobody is there to accept. So money has value provided somebody is acceptable to that. So that is, somebody should have a value. So if I give 10 rupee note to you, if you believe it has 10 rupee value, then only transactions will take place. So what value I am thinking, you are accepting it, then only you will take that money. Acceptability. Durable. So it should be stored for longer period of time. Recognizable. It should be identifiable. Difficult to counterfeit. Duplicate notes should not be there. Otherwise, many people will do this. Portable. You can take it from one place to another place. These characteristics now, these days, new things is coming. Bitcoin, cryptocurrency, where everybody is talking about it. So when you say that, is cryptocurrency a money? Ask yourself, is it acceptable? Is it durable? Is it recognizable? Is it difficult to counterfeit? Is it portable, transferable? I don't know the answer. You figure it out. Demand for money comes because of liquidity purpose, and also demand for storage purpose, meaning why money is required? For transaction purpose, that is liquidity. And I also require money not only for today transaction, for tomorrow transaction, day after tomorrow transaction, for future purpose. So that is storage. So for two reasons we need money. For today transaction, liquidity. For future transaction, today I say, that's called as storage. And we have certain theories, and we have some post-Keynesian developments. Quickly we'll run through the theories. You can just take a look at this chart once. Okay, let me go further. Okay, we have various theories about money. One, we have classical approach, the quantity theory of money. So money they're talking about, or money supply, as you can say, is the quantity, how much volume of money is available. That is M into V is P into T. That is volume or velocity, you can say, into the market value or number of transactions. Then P is price into T for transactions. Market velocity or the volume, how much the money will be in supply, depends on the price and its transaction, how many times it is being transacted. Just 1 second. Just give me 2 minutes. Are these formulas important? Yes, it is formulas. They will not ask you problems, but if they ask you a short notes, you should mention these formulas. Okay, so here M stands for money in circulation, M for money, and V stands for velocity, or you can say transactions. P is the average price level, and T is the total number of transactions. Just to give an idea, how the quantity of money will play a role. See, for example, if government prints 1,000 rupee note, this is one note we have. But how many times this is being used? Suppose A will give it to B, this note, for buying some products. Then B will give it to C, same 1,000 rupee note, and C will give it to D, same 1,000 rupee note. So three transaction took place. So 1,000 rupee note, three transaction. So the amount of supply we have is 3,000 rupees. This is what we mean by the money in circulation, 1,000 rupee, into the velocity, volume, how many times it's being used, 1,000 into 3. So value of money in supply is 3,000. So even the one note we have, but because it is used 3 times on an average, 3,000 is the money value in supply. So it focus more on money value, not about any storage value and so on. That is classical approach. Neoclassical approach, are also called as Cambridge approach, follow inventory. Inventory means you can store values. You see, classical approach focused only on transaction. How many transactions are there and how much is being paid. Number of transaction, value of transaction. That's all they concentrated. But neoclassical approach went one step further and they went for how much you are going to store the value. Inventory approach. What is the value you assign for storing, keeping the money by not spending it? That is how much amount of proportion of balance. So if you receive income 5 lakh, you will not going to spend 10%. So 50,000 will become saving, will be inventory. That's how they would they have discussed the value of money by storing the money. That is neoclassical approach. Keynesian theory went for one step further. You spend money or you don't spend money depends on the preference you have. What do you mean by that? You are having two kinds of objective, two kinds of motives. One is transactions, which is very similar to what Cambridge approach told. That is, you need the money for transaction purposes. How much your income, you spend some portion of it, and money you keep it with yourself. Why? What is the motive of money? Not only for spending today, but for safety purpose, for precautionary purpose. I might require tomorrow for emergencies. I require money. I keep money with me. That is precautionary measures, and that is not sensitive to rate of interest. So whether bank offers you more interest or less interest, you need the emergency fund always. That you will not take it out. That is precautionary purpose. Then we have speculative purpose. You have some surplus money. You don't need today, not for transaction. You don't need later. You're not saving money, but you want to generate some income out of it. So if bank gives good interest, what do? You go and deposit in bank. You get good FD interest. That is to take the advantage of change in the rate of interest and the demand money and interest, basically fluctuation in the interest rates. You are going to deposit money. That's how money will become deposits. So whether to keep the amount in cash or you make an investment in bonds, in debentures, in FD, that is speculative motive. That is what is given by Keynesian theory on money markets. Then we have post Keynesian theory. You can quickly go through this chart once. Okay. Post Keynesian theory, inventory theoretic approach. So we are having here again extension of Keynesian theory. Keynesian theory just talked about the speculative motive, but did not talk much beyond that. But here we are having two media for storing. That is, either we can keep it as an cash or we can keep it as a interest bearing asset. That is like investment in bonds. That inventory approach. If you have an excess of cash, you are going to deposit, you are going to invest in assets, not in speculative nature, for generating higher interest. So money holding is a function of number of times transfer and between the bond and money, and demand depends on cost of transfer, income from bond. Okay. This also we have one concept in, I will talk about inventory. Do you remember the formula for in EOQ in inventory in costing? You know, it is square root of 2AB by C, right? Hope you remember it. Where in inventory, there are two types of cost. One is uh, carrying cost, other is ordering cost. Correct? Carrying cost, ordering cost. And if you order more, if you produce, I mean, if you make more orders, if you if you purchase more, you order more, that means you have to hold more. Your carrying cost will increase, but number of times you go will come down. Ordering cost will reduce. But if you order less, your carrying cost will come down because you're purchasing less, you carry less, carrying cost will come down. But you have to go more number of times, ordering cost will increase. So what is that balance where carrying cost is equal to ordering cost? That is EOQ. This is the concept. Exactly the same concept you apply in money also. So how do you decide how much cash to be kept in mind? Should I keep more cash as inventory on hand or should I keep less cash on hand? If I keep more cash, if I withdraw more money, then I will store with me cash. That means my cost of carrying will increase. My opportunity cost, my income from bond, my FD interest, that will be more. If I hold more cash, I lose the opportunity of interest income. So my carrying cost will be more, uh, but my ordering cost will be less because transfer cost of transfer, meaning cost of order, will be less. But if I withdraw less money, I should do it many times. And every time I withdraw, like ordering cost, like a bank will put charges. Like you cannot have too many withdrawals. Limitation on withdrawals will be there. And every time you transfer, NEFT charges will be there. IMPS charges will be there. Even in Paytm or I think in UPI, if you do a bank mobile recharge, there will be charges. Charges will be there. That's what. If you do too many withdrawals, charges will increase, but your opportunity cost will reduce because you're not holding the much of cash. You're investing it. So to maintain the balance, that is ordering cost and carrying cost, this inventory theoretic approach is there, which is exactly same as your EOQ concept. So if they ask you this approach, write whatever you know about that EOQ. Only thing is, don't call inventory, call it as cash. This theory will come. Okay, so that's what this theory is all about. Next, Friedman's restatements. Okay, he has gone one step further. So far, what we are looking at inventory of money. At worst, we can convert it to fixed income asset like a bond, FD. But Friedman's restatement, he went beyond just cash. He went beyond just bond, not just fixed interest. What about other assets? Relative returns of other assets, whether it is permanent income or not. So you can invest for a longer period of time. Again, especially it's happening now. I should give a quick context of what is happening in India as compared to others. Now in India, what was the fixed deposit about 2-3 years back? 2-3 years back, FD rate was around 8%, 8-9% FD rate, 8 to 9%. Now what is the FD rates? The FD rates in India is around 5% now, 5 to 6%, 5% almost. Interest rates have reduced dramatically for various reasons. So what happens, because interest rate is so less, many people are not putting in FD. People are coming to equity shares because I get a better return than this. In India, at least it's 8-9-5%. Do you know what is rate of return in US? US FD rate, it's around 1%, 1-2%. That's all. So they don't want to invest the money in FD. They'll keep the money in stock market. At least 2-3% they will generate. Of course, comes with risk. That's what this statement is all about. If the relative returns on assets, that is other comparable assets, are having a better returns, then you are going to invest the money there in the other assets, which gives a higher returns, like the market I give you. Their loans are also cheaper. Yes, loans are also cheaper. That is what rate of interest is less. So you look at relative other assets comparable to the cash or fixed deposit, which can give a better return. Uh, Behavior towards risk. Again, this is very similar. Optimum portfolio ultimately depends on risk characteristic of individual. If the person likes more risk, he will invest more in bonds. He will take risk and keep less money. If the person don't want to take much of risk, he will keep the money extra and less in bonds. So behavior also depends whether you keep the money with you or you keep it in some other format. Okay, so this is regarding various theories. We have to understand money supply and monetary policies. Okay, just go through the charts, what we've done so far. I'll continue now. Okay. Money supply. Where is the money being supplied? Now it is a very important, interesting point. What is money supply? We need money. Demand comes from our transaction. But where the money will come from? First, currency, cash. What government printing? That is called as fiat money. Currency, physical cash. That is decision of the central bank. We have credit money. Banks, you have bank account, you issue checks, you do online transactions, you don't pay cash, but your bank balance is also cash for you, is also money for you. That's called as credit money. Supply response of banking system. That is credit money. Measurement, you have various levels. You can go through it. I'll just revise the important ones. M1 level, currency plus CASA. CASA means current account, saving account, bank balance basically. M2 is M1 plus post office saving bank. M3, M1 plus term deposit, FD, fixed deposit with bank. M4, M3 with term deposit and post office, but we don't consider NSA certificates. Can you email the PPTs? Whatever the charts are there that I have shared it, beyond which it will not be possible for me. So please pardon me for that. The charts, it is already given to you in the form of printout material as the charts. Okay, so determinants of money supply. Theory 1, determined by central bank. Central bank will decide how much money should be there in the banking system, how much one bank can circulate the credit money, how much balance they can maintain, what CRR they should be maintained, cash reserve ratio. So thereby they determine how much money circulation should be there. And theory 2, by changes in economic activities. That is, when activities in the economics are more, that is beyond central government. If you and me do more transactions, then money supply also will be more, and automatically vice versa less. Money supplier called as money multiplier M. Money supply is M into M base. As I told you, similarly to the earlier discussion, one currency note might be there, but how many times it is being circulated, that I multiply. That's what I mean by M. Money supply is M into money base. M represent the how many times, the volume, the money base. Determinants of money supply, behavior of central bank, their policies, stock of high powered money, that is what they control. Behavior of commercial banks, that is whether they are lenient in giving loans or transaction with customer, or they stringent, they look for too many documents, what criteria they do for giving more money as loan, those kind of thing. What is the policy of or the nature of commercial banks? Behavior of the public, that is, will you take more money from bank, will you transact more through banking channels or more through cash channels. Banking channels will be more regulated, more organized, accounting can be done. If it is through cash channels more, then accounting becomes less, it becomes less regulated. Government expenditure also will have a demand. When government starts spending money, more circulation comes to the money market, more circulation of money will be in the market, so public can spend more, transactions will be more, money supply will be more. Credit multiplier, 1 by required reserve ratio. Okay, little bit of mathematical, I'll explain you. You know, there's something called a CRR, cash reserve ratio. Cash reserve ratio. For example, if it is 5%, means what? If you have a bank, if you start a bank, if you prepare a balance sheet, you need to have balance with RBI. So if you have 100 rupees, if you get 100 rupees, 5 rupees you have to keep it with RBI. Balance 95, you can do whatever you want. Suppose now this 95 is deposited with another bank. This is bank A and this is bank B. Now, how much they have the money now? They have received 95. And how much they can invest? Not 95 entirely. Of 95, they have to keep with RBI 5% of it. The 5% of 95. The balance amount, they can use it for various proceeds. So like that, one bank to another bank to another bank, the value of money or the money supply can increase. If you imagine, instead of 100 rupees, if I make it as 1000 rupees, so 1000 means it becomes 50, you have 950, and 950 5% means 95 divided by 2, 40 something, 46 point something. So you will have remaining 904 something. So if you look at the series, this goes in a geometric progression. I mean, I don't know why I'm telling mathematics. So if I add all these values, so bank had got 1000, they have given 950, and then they have given 904 to somebody else. So if I add all these amounts, that is the total value of supply in the market. That's called as uh, credit multiplier, 1 by required reserve ratio, which means if ratio is a 5%, 1 by 0.05 means 20 times. So if you have 1000 rupees starting, 1000 into 20, by giving one bank to another bank, one bank to another bank, you can create the value up to 20,000 rupees. You have 1000 rupee, but because one giving to another, maximum you can do geometric progression, you can have 20,000 rupees total. That's what is called as money multiplier, credit multiplier, sorry. Okay, so monetary policy we have. Okay, just go to this chart, then I'll go through the monetary policy. Okay, fine. Let me run through the monetary policy. It refers to action undertaken by monetary authorities, that is in India by RBI, to control and regulate the demand for money and the supply of money. They want to control both sides. Demand for money comes from the public, who they want to spend, how much money they have, and supply of money comes from banking channels, printing of money, that is supply of money. Framework, what they need to keep it in mind: objectives, reflection of economic policy. So what government frames economic policy, that will be reflected in these measures. And you should also consider RBI, economic growth, inflation, adequate flow of credits, so that people can borrow and lend without much difficulty. It should be moderate interest rate, neither high nor low. And exchange rate stability, the foreign exchange rates, dollar and rupees, rupee and pounds, that exchange rate stability also should be considered. And what are the channels they have, measures they have? One is interest rates. They can control the interest rates. They can increase, you have something called as repo rate, reverse repo rate. I'll discuss all those things. So the RBI is the one who determines interest rates. If RBI reduce the interest rates, you and me also will get FD at lower rates. We'll get loans, home loan, car loan, housing loan, personal loan also will be at a lower rate. If they increase the rates, all of these rates also will be increased. So rates are under the control of RBI, central bank. Exchange rates, quantum of money, the money supply, printing money, asset price channel. That is, they have like bond price. They can control those measures. Operating procedures, operating procedures are operating target. We want to have a target. We want to have an inflation of so much. We want to have a GDP growth of this country at so much, like inflation. Latest, our Shaktiman Das, the RBI governor, whose term has been extended also, he told we are comfortable with inflation between 4 to 6%. If it goes beyond that, then they start taking regressive measures. They might increase the interest rates. They might reduce the printing of money. They can take the contractionary measures. That is, they will have a target like inflation between 4 to 6%, like that. Immediate targets like economic stability. So when the corona situations were there, not only in India, throughout the world, even in Fed, that is US Fed, US Central Bank, also decided to print lot of money, because when the economy was stagnant, it was like a statue, no, stopped. You wanted money circulation, so government start printing the money. We also call it as tampering, uh, Fed tampering. It has impact on stock market also. So government start pumping the money. Economy was surviving, and it was okay. But the moment they start pumping the money, we call it as tapering, tantrum. When the money circulation stopped, stock market started falling. It happened in 2011-12. Many people are fearing it might happen now also, because in a lot of places like US, India, lot of printing of money has taken place. Liquidity is injected into the system, and thereby stock market went up to the new heights. Now, if the government stop printing that money, stop injecting, reducing liquidity, stock market might fall. Some people are fearing that. Policy instruments like CRR, rates, reverse repo rate, open market operations. I would like to show you that. Indirect is OMO. I will just discuss what one by one. Uh, Operational structure. Yes, a policy committee will be there. RBI policy, MPC, which is a monetary policy committee, who comes at least 6 months once. Major policy rates, they will come and announce our RBI rate, repo rate remains unchanged, CRR remains unchanged. They keep announcing such things, and here and there also they will have a meeting. There also meeting outcome will come, but major meeting will happen 6 months once. Okay, go to this chart quickly, then I'll take up the one by one on the instruments available. Okay, let me take you one by one regarding the instruments. Okay. Before margin facility, I'll just tell you regarding repo and rates. Repo, it's called as repurchase operation. So when bank borrow money from RBI, when the bank borrow money from RBI, what rate of interest the bank has to pay? The loan what bank is taking, how much interest rate, that is called as repo rate. Then we have reverse repo, that is if reverse happens, if RBI is borrowing money from banks, and that is called as repo rate. So repo rate will always be more, reverse repo will be less. Then we have CRR, cash reserve ratio, that once a bank, you start a bank, how much money you have to keep it in cash format or balance with RBI. CRR, cash reserve ratio. And another one we have SLR, statutory liquidity ratio. That is how much of the money that you have to keep it in cash or liquid format like bonds, gold, etc. And what these ratios will help? When you have a lower ratio, for example, if CRR is 5%, if you have 100 rupees, 5 rupee you keep it with RBI, 95 rupees is available at disposal. Suppose they make this 5% as 6%. Now what will happen? I don't have 95 rupees, I will have only 94 rupees. So my balance will come down. So like this, RBI can use CRR, SLR as the expansion measures or contraction measures to increase the money supply or to decrease the money supply. Then they can ask you short notes on this and all. Liquidity Adjustment Facility, LAF. That is RBI acting as a banker's bank. So for commercial banks, for primary dealers, except for RRBs, regional rural banks, they provide liquidity on an overnight basis. You need the money for tomorrow, for 2 days. You need quick money, short-term loan. The government, RBI, is giving you the loan. At what rate? At LAF, acting against the collateral or government securities. Instruments can be repo rates, it can be reverse repo rate, or it can be any instruments, and reported in NDS, that is National Dealing System. I think this is basically a, uh, instrument or a software where all the transactions are reported. So liquidity adjustment facility, LAF, is RBI acting as a banker. Commercial banks, ICICI Bank, HDFC Bank, Bank of Baroda requires loan for a short term purpose. How do they get loan? You go for RBI, they will help you with the loan by taking collateral against the government securities at the rate of interest, maybe repo, reverse repo, etc. Then MSF, marginal standing facility. Here RBI is acting as a lender of last resort. That is, bankers is suffering. Now they need money. They have exaggerated everywhere else. It is exhausted. So as a last resort, you come to the RBI and please help me. RBI will help you, which is exceeding LAF. First of all, you will have the facility, liquidity adjustment facility. But beyond that, if you want, as a last measure, RBI will reduce by giving reducing SLR. So you can keep at a statutory liquid ratio. You can keep lesser amount, but they'll charge you a higher interest, penal rate of interest. So it's, if any unexpected liquidity shocks come to banking system, suddenly money is not there. Yes, bank. Suddenly there is a scam outbreak and people are withdrawing the money. They are standing in the queue in front of Yes Bank to withdraw their own money. Yes Bank is out of money. They need money. Nobody else giving loan. RBI, as a lender of last resort, lends money at a penal rate. So even public interest is taken care. So this regarding money markets and money markets, demand, operations, and monetary supply. So please go through it quickly. Okay. So let's take a break now. We have one chapter left, international trade. So 3:30 now. Let's take a break of 15 minutes. Let's meet at 3:45 and we'll take up the last chapter, international trade. So let's meet at 3:45, 15 minutes break.